Imagine it's 15th of March, 2022. You're a 37-year-old housing worker living in central South Carolina, United States. For months, you have used stimulus checks and every extra dollar you could save to pay down your credit card debt, and your credit score has climbed by almost 100 points. You are hunting for a modest house priced between $175,000 and $225,000 before your lease runs out at the end of May. At night, you scroll through listings that vanish almost as soon as they appear, like fish breaking the surface and disappearing back into dark water. 4 offers have already been rejected, and each rejection makes the market feel less like a neighborhood and more like a locked gate. If you have ever wondered why a house can feel safest right before it becomes most dangerous, stay with me. What you're about to hear is not a theory. It is a pattern. It has happened before in different countries, in different decades, under different flags. And if you find value in this kind of historical clarity, subscribing takes 2 seconds and keeps you ahead of what most people never see coming. Now the turn comes. Mortgage rates rise fast enough that the amount you can borrow begins shrinking while you're still looking. Cash buyers keep stepping over you. Investors keep stepping around you. And what looked, from far away, like a normal housing market starts to reveal a harsher truth. By the end of 2021, households earning the median income needed to spend nearly 33% of their income to afford payments on a median-priced American home, a level the Atlanta Federal Reserve said was the lowest affordability reading since 2008. In March 2022, Brianna Lombardozzi told Reuters she felt defeated, not irresponsible, not reckless, defeated. But that word matters, because it tells you something deeper than a chart can. It tells you the stress had already entered the lives of ordinary buyers, long before any headline used the word crisis. And that is what this video is about. Not a prediction, not a panic, a pattern. History shows that buying a house becomes unusually risky when people stop paying for shelter and start paying for a story that rates will fall soon, a story that prices only pause, never reverse, a story that refinancing will always be there, a story that if you can somehow get in, the market itself will save you. But houses are not magic. They are expensive, illiquid assets, which means hard to sell assets, usually bought with borrowed money. And when high prices, high rates, rising insurance, thin savings, and economic uncertainty pile on top of one another, the house stops behaving like a home and starts behaving like a liver. A lever can lift you. It can also crush you. That is why buying a house in 2026 may be riskier than most people think. Before we go further, there is something important to understand. A housing market usually does not break because people suddenly forget how to build houses or sign contracts. It breaks because the hidden math changes. Think of a house like a ship crossing a cold sea. The paint, the deck, the polished wood, that is the listing photo. The real story is below the waterline where the weight sits. The weight is the loan, the rate, the taxes, the insurance, the repairs, the job that must keep paying for all of it. When buyers have margin, which means room to absorb bad luck, the ship stays upright even in rough water. When buyers are packed at the edge, one wave is enough. That is the core mechanism. Leverage. Leverage means using borrowed money to control something expensive. It makes gains feel larger on the way up because a small rise in price creates the illusion of easy wealth, but it makes losses far more dangerous on the way down because even a modest fall can wipe out years of savings. A buyer who puts 10% down does not need prices to collapse by 50% to feel pain. A much smaller move can do the job. And even if prices do not fall much, the monthly payment can still become unbearable if rates, taxes, insurance, or income move the wrong way. This is why the real danger is often not the dramatic crash people imagine. It is the quieter trap. You buy at a price that only works if life stays perfect. Then life does what life always does. A job changes, a child arrives, a parent gets sick, property insurance jumps, the roof leaks, the city reassesses taxes. The market cools just enough that selling would mean taking a loss, but not enough to produce a headline that warns you. Collapse is rarely a lightning strike. More often, it is a floorboard softening beneath a carpet, year after year, until somebody finally steps in the wrong place. This brings us directly to the first part of the story. The first major pattern is that easy credit can make a dangerous market look safe. In the United States, in the early and mid-2000s, lenders pushed mortgages far beyond the old limits. Loans went to borrowers with weaker credit histories, thinner down payments, and loan structures that only worked if prices kept rising. Wall Street repackaged these mortgages into securities and sold them to investors, which meant the person making the loan often did not carry the long-term risk. Risk was being moved around the system like hot coal in a dark room. Everyone assumed someone else had gloves on. The effect was powerful. More credit meant more buyers. More buyers meant higher prices. Higher prices then seemed to prove the lenders right. If a borrower struggled, he could refinance. If she panicked, she could sell. Rising prices covered mistakes the way fresh snow covers broken branches, and because this cycle lasted long enough, people began to confuse a temporary condition with a permanent law. The Federal Reserve's History of the Subprime Mortgage Crisis describes exactly how this happened. As funding for riskier mortgages expanded, especially through private label mortgage-backed securities, credit became easier to get and home ownership rose. The demand this created pushed prices higher, especially in tight markets. That, in turn, encouraged even more lending. The market was not climbing a staircase, it was climbing its own reflection. Then the reflection cracked. When house prices peaked, refinancing became harder. Selling became harder. In April 2007, New Century Financial, one of the leading subprime lenders, filed for bankruptcy. Large volumes of mortgage-backed securities were downgraded. Subprime and other non-prime lending started drying up. And once the credit stopped expanding, housing demand weakened. Prices fell. Falling prices made it harder for troubled borrowers to escape. That led to more distress selling, more foreclosures, and still lower prices. The staircase had become a trapdoor. The human scale of this is easy to underestimate unless you slow down and look at the numbers. A Hoodie report found that foreclosure starts across all market segments reached nearly 2 million loans in 2008. More than 850,000 of those were in the prime market, which means the pain had spread far beyond the stereotypical subprime borrower. Reuters reported that in 2009, a record 2.8 million U.S. properties with a mortgage received a foreclosure notice, up 21% from 2008, and 1 in every 45 households got at least one filing. The same Reuters report said prices had toppled nearly 30% from their 2006 peak through October 2009. Federal Reserve history adds that home prices fell by more than a fifth on average nationwide from the first quarter of 2007 to the second quarter of 2011. What did ordinary people actually experience? Not abstract losses, real ones. Lost down payments, lost jobs in construction and finance. Neighborhoods filled with bank-owned homes. Families who had counted on refinancing discovered the door had vanished. Renters were hit too because foreclosures also struck absentee-owned rental properties. A house was supposed to be a ladder into the middle class. For millions, it turned into a chute. And this is the most uncomfortable part. Many of the people caught in that storm were not cartoonishly reckless. They were operating inside a system that rewarded stretching. The market was telling them that waiting was dangerous and buying was prudent. When a whole society starts treating overpayment as discipline, the warning signs become almost invisible. That is one reason buying a house can be most dangerous precisely when it feels most normal. Here is something I want you to think about before we go further. If a bubble bursts and interest rates later fall to almost nothing, should that not make housing safe again? Drop your answer in the comments. Seriously, because what I am about to show you next is the part of this story that most people never hear, and it changes everything. This leads to the second part of the story. The second major pattern is that once a country buys homes and land at fantasy prices, lower rates later do not magically rescue the people who bought at the top. Japan showed this with almost laboratory clarity. During the late 1980s, Japan's asset bubble pushed both stock prices and land values into territory that seemed almost absurd even at the time. The Nikkei 225 rose to 38,957.44 on 29th of December 1989, more than tripling from the middle of the decade. By 1991, commercial land prices in Japan's 6 major cities were up 302.9% from 1985. Residential land was up 180.5%. At the peak, land under the Tokyo Imperial Palace was famously said to be worth more than all the real estate in California. That kind of number does something to the mind. It does not merely attract speculation. It changes what feels reasonable. Borrowing against land seems prudent because land itself appears to be a money machine. Banks treat collateral as if it has acquired moral virtue. Companies borrow against real estate. Families stretch for homes because the next year looks worse. The price is no longer the warning. The price becomes the advertisement. Then the bubble burst. Japan's stock and real estate collapse began around 1989 to 1991. According to Investopedia's summary of the period, equity values plunged 60% from late 1989 to August 1992, while land values kept falling through the 1990s and were down about 70% by 2001. That alone would have been brutal. But the deeper damage came from what the European Central Bank later called a long balance sheet adjustment. That phrase sounds technical, so let me put it plainly. When the thing backing your debt collapses in value, you stop thinking about growth and start thinking about survival. You save more, you spend less, you try to repair your finances. If millions of households and firms do that at the same time, the economy starts moving like a body with weights tied to its ankles. Japan is important because it destroys a popular simplification. Many people assume high rates are the problem and low rates are the cure. But after the bubble burst, Japan cut rates dramatically. It still suffered years of stagnation. The ECB noted that a sustained recovery did not really take hold before 2003, and that credit growth did not turn positive until 2005. Why? Because cheap money cannot fix a purchase made at a wildly inflated price if the buyer's balance sheet is already damaged. A life jacket does not help much if the anchor is still tied to your waist. Ordinary people in Japan experienced this not as one cinematic crash, but as a long dimming. Wages stalled, confidence fell, companies with bad collateral cut back, banks weighed down by losses hesitated to lend. The dream of permanent appreciation became a generation of caution. And that is one of the most counterintuitive lessons in housing history. Sometimes the biggest risk is not a fast collapse. It is buying into a slow one. A slow decline can steal more years than a sharp drop because it keeps households frozen. They cannot move without realizing losses. They cannot borrow freely. They cannot pretend the purchase never happened. Time itself becomes part of the bill. Now here is where it gets interesting. The third major pattern is social pressure. At the top of a housing boom, dangerous prices rarely feel dangerous because the whole society begins leaning in the same direction. Ireland during the 2000s is one of the clearest examples. During the Celtic Tiger years, which means the long boom that transformed the Irish economy, property was not just an asset class. It was a national mood. Builders built, banks lent, families rushed, politicians celebrated. The same wind filled every sail. And then came the arithmetic. Morgan Kelly, the Irish economist who became famous for warning about the crash, later pointed out how extreme the lending had become. In 2006, the average first-time buyer in Ireland borrowed 8 times average annual earnings. A decade earlier, the average had been closer to 3 times earnings. He also noted that the average new house cost 10 times average earnings, while second-hand houses in Dublin were selling for 17 times earnings. Those are not merely high numbers. They are a sign that a market has stopped asking what a household can sustainably carry and started asking how much pressure a household can survive. The lending standards followed the mood. Reuters later reported the case of Jason and Orlay O'Connor, who took out a €500,000 mortgage to buy the family home. Jason had to work overtime to meet the repayments. Orlay had no regular income. When she asked what self-certifying income meant, she said the lender told her to pick a number. That sentence should be framed and hung on the wall of every housing mania in history. Pick a number. At the top, the market stops measuring reality and starts editing it. Then the crash came. Reuters said Ireland's 2008 collapse halved house prices and led to the most expensive bank rescue in the Eurozone. By 2011, the BBC reported that an estimated 300,000 homeowners in the Republic of Ireland had mortgages bigger than the value of their homes. In 2012, Reuters reported that over half of all Irish mortgages were in negative equity, which means the debt was larger than the home value. Years later, the damage was still visible. Reuters reported in 2018 that of Ireland's €100 billion in residential mortgages outstanding, €10 billion were non-performing, or more than 90 days in arrears. About €6.5 billion were more than 2 years overdue. Look at what happened next in the O'Connors' own life. By 2018, they were €75,000 in arrears and had barely dented the principal. Jason had lost the technical job he once held for 13 years. They were paying €2,000 a month on a loan that required $2,500. They had already been called to court multiple times. Orlay described the paperwork arriving at the door and then suddenly being in court without the money for a solicitor. That is what housing risk looks like when it stops being a line on a spreadsheet. It looks like grief arriving in envelopes. And this is where history gets uncomfortable. Ireland's lesson was not simply that prices can fall. Everyone knows that in theory. The deeper lesson is that a housing market becomes dangerous when normal people must use extraordinary assumptions just to participate. Over time, that never stops. Income that is not yet real, rates that must stay low, prices that must stay high, employment that must stay secure. A house bought on those terms is not a shelter. It is a machine that feeds on the future. There was another cost that charts struggle to show. Ireland's crash froze people in place. Negative equity did not only destroy wealth, it stole motion. A family could not easily move for work because selling meant locking in a loss. A couple could not easily separate finances after divorce because the house debt sat between them like wet concrete. Young adults postponed plans. Parents worried about adult children. Unfinished developments, the infamous ghost estates, became physical reminders that a boom can leave behind not just losses but half-built promises. A housing bubble is often described as excess optimism. In reality, once it bursts, it behaves more like glue. Most people will never know what you now know. Most people will keep trusting systems they do not understand. If you are still here, you are not most people. Hit subscribe, because the next section is the part this channel was made for, the part they never put in textbooks. Now observe what all of these cases have in common. The same mechanism, different countries, different decades, same result. In the United States, in Japan, and in Ireland, prices outran incomes. Credit expanded to bridge the gap. Rising prices then seemed to justify the credit. Collateral values went up, which encouraged more lending, which pushed prices higher, which convinced buyers that getting in at any price was safer than waiting. The market was not a house, it was a hall of mirrors. Then one of three things happened. Rates rose, credit standards tightened, or incomes and jobs weakened, sometimes all three. Once that happened, the system reversed. People who needed to refinance could not. People who needed to sell discovered the buyer pool was thinner than it looked. Because houses are bought with leverage, even a moderate decline could erase equity. And because houses are illiquid, sellers could not always escape quickly. A stock can be sold in seconds. A house can sit and sit and sit while the bills keep coming. Now put current conditions next to that historical pattern. In 2024, Harvard's Joint Center for Housing Studies found that the national median single-family home price had risen to 5 times the median household income, near prior record highs. In 2019, that ratio was 4.1. In the 1990s, it was 3.2. Between 2019 and 2024, national median single-family home prices rose by 48%, while median incomes rose by 22%. In March 2025, Redfin said the typical U.S. homebuyer's monthly housing payment hit a record $2,807, driven by a median sale price up 3% year over year and a mortgage rate around 6.67%. In May 2025, Realtor.com found that 47 of the 50 largest U.S. metros were unaffordable for the typical household under the 30% rule, assuming a 6.82% mortgage rate, a 20% down payment, and taxes and insurance equal to 1.72% of the home price annually. And the strain does not stop at mortgage rates. In September 2025, ICE Mortgage Technology reported that average annual property insurance payments for mortgaged single-family homeowners had climbed to nearly $2,170 a year. Insurance alone accounted for 9.6% of average monthly mortgage-related expenses and had risen nearly 70% over the previous 5.5 years. That matters because buyers often look at the headline price and the mortgage rate while underestimating the other ropes tied to the purchase. A house is never just principal and interest. It is a bundle of commitments. The social profile of the buyer is also telling a story. NR reported that the median age of the first-time buyer had risen to 38, an all-time high. All cash buyers made up 26% of purchases. Multi-generational households made up 17%. First-time buyers were putting down 9%, the highest share in nearly 30 years. Read that slowly. Older buyers, more cash, more pooled family income, higher barriers to entry. That is not what a relaxed market looks like. That is what a strained market looks like when it learns to hide its strain behind normal transactions. This brings us directly to the human cost. Who gets hurt most when housing becomes a stretch market? Usually not the people with large cash reserves, paid-off assets, or the ability to wait a decade. It is the people who need flexibility. First-time buyers, young families, single-income households. People whose jobs are cyclical, which means they rise and fall with the economy. Pensioners who guaranteed a child's loan. Small business owners whose income looks solid in good years and fragile in bad ones. Renters, too, because when ownership systems crack, the shock often spills into the rental market. Spain showed this in grim detail after 2007. Human Rights Watch reported that Spain's burst housing bubble combined with economic collapse and weak borrower protections produced a social disaster. Unemployment climbed to almost 5 million people, nearly 26% of the economically active population. Between 2007 and 2011, banks initiated 438 foreclosure proceedings. Between 2008 and 2011, courts ordered repossession and eviction in 166,716 proceedings. The Bank of Spain later reported 39,51 repossessions of primary residences in 2012 and another 28,170 in the first half of 2013. Many borrowers still owed large debts even after losing the home itself. The house was gone. The liability remained, like being thrown from the carriage and still being charged for the ride. The faces inside those numbers matter. Reuters photographed Vicente Torres, a severely ill 74-year-old pensioner in Madrid, being comforted by family in April 2012, after learning that his eviction had been suspended only until May 3rd. He faced eviction not for a speculative empire, but because he had acted as guarantor for his son. That is another pattern history repeats. Housing booms do not stay neatly inside the mortgage contract. They spread through families. They pull grandparents, siblings, and children into the same debt weather. Even years later, the social aftershocks were still visible. In Barcelona in 2021, Reuters reported on Noemi Osset, a 45-year-old woman with a visual disability and chronic illness who kept bags by the door in case eviction officials returned. Spain had one of Europe's smallest social housing pools, less than 2% of all homes. Private rents had risen by almost 50% between 2013 and 2019, while salaries lost nearly 8% of their buying power between 2010 and 2019. That is what makes housing crises so brutal. They do not end when the price chart stops falling. They linger in schools, clinics, marriages, commutes, and children's sense of stability. Housing distress is not a storm that passes overhead. It is water that gets into the walls. Sweden offers another angle on the same truth. After financial deregulation in the mid-1980s, credit expanded rapidly and property values soared. Research on Sweden's crisis later found that prices for multifamily properties fell about 35% from their 1990 peak, while one and two-family prices fell about 20% from their 1991 peak. Reuters noted that Sweden's 1990s property collapse helped force the rescue of two banks. The institutions had plans. The households had consequences. That is the split worth remembering. Systems move to protect their core plumbing first. Families absorb the weighting. Who, then, walks away relatively fine? Usually the buyers with low debt, the owners with large equity cushions, the institutions that can refinance from one year to the next, and the cash-rich investors waiting at the edge of the field. In almost every housing downturn, the people who arrive with patience and liquidity meet the people who have run out of both. One side sees distress. The other sees inventory. That is why housing busts often widen inequality even when they begin in the middle class. The family that needed one stable house ends up weaker. The buyer with cash ends up stronger. The crisis does not spread losses evenly like rain over a street. It pours through the cracks that were already there. This is also why current affordability stress matters even before any crash arrives. When first-time buyers need help from relatives, when repeat buyers can roll old equity into new purchases, when insurers, lenders, and tax assessors each take a larger bite, the burden does not fall equally on everyone. It falls heaviest on the household trying to enter with a mortgage and no margin. The market starts sorting people into two groups, those buying from cash flow and those buying from strain. That sorting can continue for years before the public decides to call it a problem. And here is one of the strangest historical facts of all. Reuters once reported on a unique Dutch housing index based on homes along Amsterdam's Herengracht Canal. Over very long stretches of history, real house prices there were volatile but broadly flat. After the French occupation in 1795, values on that prime canal reportedly tumbled 80%. The phrase, safe as houses, sounds comforting. History suggests it is often just another way of saying we have short memories. The question is not whether this pattern will repeat. History has already answered that. The only question is whether you will see it before it sees you. If this channel helps you think differently about the world you live in, subscribe. It costs nothing, and it might change everything. The historical record shows that those who came through these periods largely shared three characteristics. Not because they were geniuses, not because they owned secret data, but because they had room. First, they carried less leverage relative to their income. In plain English, they were not depending on a perfect future to justify the purchase. In the United States, households with meaningful equity, fixed payments, and some cash reserves had something precious during the crisis: time. Time is oxygen in a housing downturn. If you can keep paying and avoid a forced sale, you can survive conditions that destroy a more stretched household. Second, the survivors usually had liquidity or flexibility. That could mean savings. It could mean family support. It could mean a household structure that could absorb a shock. In today's market, the buyer profile itself hints at this. All cash buyers at 26% and multi-generational buyers at 17% tell you who has the cushion. In earlier crises, those with spare cash or strong income could wait, negotiate, or even buy distressed assets after the panic. Those without liquidity were like climbers on a cliff with no resting ledge. One slip in gravity made the next decision for them. Third, the survivors treated the house as shelter first and investment second. That may sound obvious, but at the top of booms it becomes a radical idea. In Japan, the buyers and firms most damaged were often those who had treated land appreciation as part of the business model itself. In the US bubble, borrowers who expected refinancing or appreciation to save them discovered that a house cannot rescue a balance sheet already built on hope. In Ireland, families who had to assume endless overtime, rising wages, or forever cheap credit discovered the same thing from a different angle. Notice what all three characteristics have in common. They are forms of margin. Margin is what lets a ship survive a wave, what lets a bridge carry extra weight, what lets a household absorb the surprise that life always delivers. The market in 2026 may or may not punish every buyer. History does not work like a calendar alarm. But when a housing market increasingly depends on older buyers, inherited wealth, cash offers, pooled family incomes, and extreme patience, it is telling you that margin is scarce. Only the larger boats can move easily through the channel. So let us return to Brianna Lombardozzi in central South Carolina. On 15th of March 2022, she was not behaving recklessly. She had paid down debt, improved her credit score, saved money, looked for a modest house and a defined budget. She did what responsible people are told to do. And still the ground shifted under her because mortgage rates rose, cash buyers kept winning, and affordability had already tightened before the average buyer fully understood how far it had tightened. Her story did not begin with a crash. It began with a market asking an ordinary person to be extraordinary just to get in. That is the final lesson. The risk in buying a house in 2026 is not simply that prices could fall. History shows something subtler and more dangerous. Risk rises when buyers mistake market activity for market health. When they see listings, open houses, and smiling agents, but miss the strain underneath. Prices far above incomes, payments at records, insurance rising fast, first-time buyers getting older, more households needing cash or family help just to qualify. A house becomes dangerous quietly, not when everyone is afraid, but when the culture around it becomes too confident, too stretched, too willing to treat future luck as current income. This is historical and educational analysis. It is not financial advice. Every individual situation is different. Please consult a qualified professional before making any financial decision. This video is not for everyone. Most people will dismiss it. But if one person in your life needs to hear this, share it with them. Not because it will change the world, because it might change their world. Subscribe for more, and I will see you in the next one.